Let me open with a line that is going to sound backward on purpose. If your rental property loses money on paper, that might be the most profitable thing it does for you all year. Now, I can already hear someone saying, Mo, losing money is not a strategy. And I agree, losing real money is not a strategy. But losing money on paper because the tax code allows you to recover the cost of an asset over time, well, that is not a loophole. That is the system working exactly as designed. And now that we're in 2026, this conversation is more timely than ever because the IRS just issued new guidance on 100% bonus depreciation. After the One Big Beautiful Bill Act made 100% bonus depreciation permanent again for eligible properties acquired after January 19th of 2025. Now, this is not trivia for accountants. This is a real planning window for investors who understand what qualifies, what does not, and how to use it inside of a long-term strategy. But I want to frame this the right way because a lot of real estate content online is either overhyped or incomplete. People make it sound like depreciation is free money and cost segregation is a cheat code. But here's the truth. Depreciation can be a wealth building tool, but only if you answer the questions your future self is going to ask you later. Questions like, can I actually use these deductions this year? What happens when I sell? Will this create a surprise tax bill? How does this fit with my refinancing, cash flow, and long-term planning? So today, we're going to do this the AMG way, with a structure that actually helps you make decisions. We're going to intro this topic with clarity. We're going to explain how depreciation works in real estate in plain English. We're going to illustrate the math with examples that feel real. We're going to connect it to the bigger issues, passive loss limits, recapture, and exit planning. And then we're going to apply it, a rules-based approach you can use to think through depreciation decisions like an adult, not like someone chasing a write-off. If you're a real estate investor, if you're considering buying property, or even if you already own rentals but you're not confident you're using depreciation correctly, this is for you. Let's start with the simplest definition. Depreciation is cost recovery. The IRS looks at buildings and many improvements and says, these assets have a useful life. You should be able to recover your cost over time. So instead of deducting the entire purchase price in 1 year, you deduct it over a schedule. Here's the first rule of real estate depreciation, and it matters more than most people think. You do not depreciate land. Land is considered non-depreciable because it does not wear out in the IRS's eyes. Buildings and improvements do. That means when you buy a rental property, you have to allocate the purchase price between the land and building. The building portion is what gets depreciated. Here's the second rule. The depreciation schedule depends on what kind of property it is. Residential rental property, so think long-term rentals like single-family homes, duplexes, and small multifamily. These are all generally depreciated over 27 and a half years. Commercial property is generally depreciated over 39 years. Now that's your baseline. That's the normal rhythm. Now here's where it gets interesting. Depreciation is a non-cash expense. That means it reduces taxable income even though no money left your bank account to pay the depreciation that year. You paid the property when you bought it. Depreciation is simply the tax code letting you recover that cost over time. This is why real estate can feel like a different game. You can collect rent, you can pay your actual expenses, you can still have positive cash flow, and yet show a paper loss because depreciation reduces taxable income. Now, before you get excited, I need to say the part most people skip. A deduction is only valuable if you can use it. That one sentence will save you a lot of disappointment because real estate has another layer of rules that control whether your depreciation-driven losses can offset other income, like W-2 income or business income. We're going to get to that in the Connect section because that's where passive activity rules, real estate professional status, and short-term rental exemptions come into play. First, let's make sure the fundamentals are clear. Let me give you an example that is simple enough to follow, but real enough to matter. Say you buy a long-term rental for $1 million. Now you cannot depreciate the land, so you allocate part of the purchase price to the land. So let's say $200,000 is land and $800,000 is building. If it's a residential rental property, that $800,000 building basis is typically depreciated over 27 and a half years. So rough math, 800,000 divided by 27.5 is about $29,000 of depreciation per year. So what does that mean in real life? It means that if your rental produces, say, $29,000 of taxable rental income, after expenses, depreciation could potentially reduce that taxable income to near zero. And if your rental produces less income than that, you might even show a paper loss. Now, here's the real moment line you can clip because it matters. Your property can be profitable in the bank account and unprofitable to the tax return at the same time. This is the point of depreciation. Now, let's make it more interesting. Most investors just don't buy a property and leave it untouched. They renovate, they improve, they add HVAC systems, they upgrade flooring, they redo kitchens, they add parking lots or fencing or landscape improvements. And the question becomes, how are these costs depreciated? Some improvements get depreciated over long schedules, some qualify for shorter schedules. And this is where cost segregation enters the conversation. Cost segregation is a process where an engineer-backed study breaks a property into different components with different depreciation lives. The building itself might be 27 and a half years or 39 years, but certain components, think appliances, specific electrical and plumbing components, certain flooring, land improvements, can be classified as a 5-year, 7-year, or 15-year property. And why does that matter? Because shorter life property depreciates faster. And when bonus depreciation is available, shorter life property can potentially be accelerated dramatically, sometimes into year 1. Now let's be careful with language. Bonus depreciation does not turn your whole building into a 1-year deduction. Your 27 and a half or 39-year structure is still long life property. But cost segregation can reclassify certain parts into categories that may qualify for accelerated depreciation. This is why people talk about cost segregation like it's a superpower. But I want you to hear the warning inside the opportunity. Cost segregation is not a strategy. It is a tool. And if you use that tool without understanding passive loss rules and recapture, you can create the illusion of a tax win while storing up a future tax problem. Let me illustrate that with a simple version of what investors see. Using the same $1 million property with 800,000 building basis, imagine a cost segregation study identifies $200,000 of components that qualify as 5-year, 7-year, or 15-year property. If those components qualify for 100% bonus depreciation under current law and guidance, you might be able to accelerate a significant portion of that $200,000 into year 1 depreciation. So instead of $29,000 of depreciation, you might see a larger deduction in year 1. This is where people get excited, and I understand why. A big deduction can reduce taxable income and preserve cash flow. But again, a deduction is only valuable if you can use it. And if you can't use it, you still must plan for what happens later. Now let's connect depreciation to the big 3 realities that determine whether this is a wealth strategy or a future headache. Reality number 1, passive activity rules. Reality number 2, depreciation recapture. And reality number 3, your exit plan. So let's start with passive activity rules, because this is where many high-income investors get confused. In general, rental real estate activities are considered passive activities for tax purposes, even if you feel like you're doing a lot of work. Passive losses generally can only offset passive income. They cannot offset W-2 income. There is a special allowance that can permit up to $25,000 of losses to offset non-passive income if you actively participate, but that allowance phases out at higher income levels, which means many high earners cannot use it. So here's the real world implication. A lot of successful people generate big depreciation deductions, show large paper losses, and then realize those losses are suspended and carried forward because they don't have passive income to offset. Now, this is not always a bad thing. Suspended losses can be used in future years against passive income, and they may become usable upon disposition of the property under certain circumstances. But it matters for planning because if your plan was, I'm going to buy real estate, do cost segregation, and wipe out my W 2 income, the passive activity rules may stop that plan cold unless you qualify for exemptions. This is where two concepts show up in investor circles: real estate professional status and the short-term rental exemption. Real estate professional status is a specific tax classification. It has requirements around time spent in real estate and material participation. It is not something you casually claim because you feel like you worked hard. The rules are strict and documentation matters. Short-term rentals can sometimes be treated differently from long-term rentals for passive activity purposes if they meet certain criteria and you materially participate. This is why you hear people talk about short-term rental loophole. It's not a magic loophole. It's their interaction of passive activity rules with what is or is not considered a rental activity under those rules. Here's the AMG version of the advice. Do not build your financial plan around a tax exemption you don't fully understand and can't document. If you want to pursue those strategies, you do it with a successful team, tax planning, and investment strategy all aligned, because you want to win the strategy and survive the audit, not just impress your friends at dinner. Now let's talk about depreciation recapture, because this is the part that separates people who are paying taxes from people who are planning for wealth. Depreciation reduces your basis. Basis is your tax starting point. If you buy property for $1 million and allocate $200,000 to land and $800,000 to building, your depreciable basis is $800,000. Every year you take depreciation, your adjusted basis declines. So, what happens when you sell? The IRS calculates gain based on the sale price minus adjusted basis. If you took depreciation, your adjusted basis is lower, which generally increases your gain. And then the IRS looks at a part of that gain and says, we're going to tax the portion related to the depreciation differently. For real estate, this often shows up as unrecaptured Section 125 gain, taxed at a minimum 25% rate on the portion of gain attributable to depreciation, with remaining long-term gain potentially taxed at long-term capital gain rates, depending on your income. So when people say depreciation is free, depreciation is not free. The IRS lets you take the deduction now, but they keep the receipt. Now let me illustrate recapture with numbers because vague warnings do not change behavior. Now let's go back to the simple property. You buy for $1 million. Land is $200,000. Building is $800,000. Over several years, you take $200,000 of depreciation deductions. Now your adjusted basis in the property has declined by the depreciation. Very simplified, your adjusted basis would be the original basis minus depreciation taken. So $1 million minus $200,000 would be $800,000 adjusted basis, ignoring other adjustments. Now imagine you sell the property for $1.2 million. Your gain is the sale price minus the adjusted basis. So $1.2 million minus $800,000 is $400,000 of gain. The IRS then looks at how much depreciation you took. The portion of gain attributable to depreciation can be subject to the recaptured 125 treatment, up to 25%. The rest can be taxed as regular long-term capital gain. That's the high-level logic. So what does this mean in planning terms? It means depreciation is a timing benefit. You're often shifting taxes, not eliminating them. And shifting taxes can be extremely valuable if it improves cash flow, increases reinvestment ability, supports acquisition strategy, or aligns with estate planning. But you must know what you're shifting and when it comes due. This leads to the holding period question that real estate investors ask. How long should you hold a property if you use aggressive depreciation or cost segregation? Well, there is no universal number, but there is a planning principle. If you accelerate depreciation into year one and then sell quickly, you may create a large recapture bill before the investment has had time to compound and before the strategy has delivered long-term benefits. If you accelerate depreciation with a long-term plan, holding, refinancing, repositioning, exchanging, or coordinating with estate planning, you can often manage the tax impact more intelligently. Now, this is where exit planning becomes critical. There are strategies that can defer or manage tax at sale, like a properly executed 1031 exchange. That is a highly technical process with strict rules and timelines. But for investors who are building a portfolio, it can be part of the plan. There is also the reality that many long-term investors plan to hold assets for life. Estate planning considerations like what happens to basis at death can be part of how families think about the long game. These are sensitive topics and must be planned properly, but they matter. This is why we keep returning to the same theme. Depreciation is not a tax topic. Depreciation is a wealth planning topic. Now let's apply this in a rules-based way. Not hype, not theory, a practical approach you can use to think through depreciation as a real estate investor. Step one is to get the basics right. Allocate purchase price properly between land and building. Track the placed in-service date and keep good records. The most sophisticated strategy in the world fails if the foundation is sloppy. Step two is to know what kind of property you own and what kind of investor you are. Are you a long-term rental investor? Are you a short-term rental operator? Are you an active real estate professional? Are you passive? Your depreciation strategy must match your tax reality. Step three is to decide whether cost segregation is appropriate, and if so, when. Cost segregation can create powerful acceleration, but you want it to be defensible, engineered, and coordinated. If you're going to do it, it should be done correctly, with the right professionals, and with your whole plan in view. Step four is to match depreciation to the year you can actually use it. If passive loss limits mean your losses will be suspended, you need to know that before you celebrate. Suspended losses may be useful, but you should plan for when and how they will be used. Step five is to plan the full life cycle. Model the sale. Understand recapture. Decide whether this is a refinance and hold asset, a reposition and exchange asset, or a sell and redeploy asset. You should know your exit logic before you buy, not when you get an unsolicited offer 3 years later. Now here's the teaser, because in the next video, we're going to go even deeper and more tactical. In the next episode, we're going to walk through cost segregation in real estate like adults. What it is, what it's not, what qualifies, what documentation matters, how bonus depreciation interacts with it under the current IRS guidance, and most common mistakes that get investors in trouble. We're also going to answer one of the most important questions high-income investors ask. If depreciation is so powerful, why do some investors still feel broke, stressed, and stuck even while their tax returns show a huge paper loss? Because tax strategy without a cash flow strategy is just a clever-looking spreadsheet. If you want to win in real estate, depreciation must support cash flow, risk management, and long-term planning, not just this year's tax bill. I'm Mo Param, and if this video helped you, share it with a real estate investor who keeps hearing the word depreciation but does not have a system for using it. And if you want a plan that connects your portfolio, your taxes, your cash flow, and your long-term goals, that's exactly what we do. I'll see you in the next one.